Good evening. This is Ken Long from Tortoise Capital, and I want to talk a little bit about our common operating picture. That is our regression line crossover framework, which incorporates a variety of technical indicators that help us describe with some precision what it is that we see so that when we talk about price and momentum and risk and reward, we can express ourselves in a common language with adaptive measures that adjust to market conditions and which give meaning to our sensory data and allow us to exercise disciplined action. So from a distance, there's a lot of things going on here. This is looking at about 2.5 or 3 years of symbol DIA, the Dow 30 Industrials, using daily settings. And we're using freestockcharts.com as our platform because it's widely accessible, has real-time data, nice palette of tools, and is a reliable platform. The paid version has even more power, and they're putting in place a brokerage system, so it can be a complete execution system, but we're using the free version right now just for accessibility. I'm using Chrome, and so you'll notice this gray area over here. The free version has some adware that would go in there. I spend $10 and give the guys an ad blocker, a token of my esteem for their work in suppressing advertising. I've reduced that space by coming up here into Chrome and reducing the size. What that does is makes the symbol area unreadable, but maximizes the screen space and minimizes the area of the advertising. So if I move it back to something a little more reasonable, like 67%, I can still see my symbols. I can see their performances. I can see my palette of drawing tools, the different tabs for the different chart patterns that I've put together, and still minimize the area of the ad. And that gives me some screen space to work with. The little toggle down here lets me adjust how much data I want to see. We're going to see how our framework allows us to see this period of collapsing volatility begin to expand in our favor. When the dragon came out of the river, found a double bottom, started to flow, price crosses over the long-term fair value of the RL270 in the purple. The 10 and the 30 period regression lines leaving the river along with price, indicating the beginning of trending behavior, allowing us to buy at the green arrow with a stop below the Bollinger Band mean, the center of the river, with a target at the top of the dragon's previous highest hump, giving us a favorable reward to risk ratio, and then allowing us to manage this trade in an orderly fashion as the herd, which is the price, has left the river, marching northward, escorted by the river dragon, which keeps it from coming back into the river until it gets too thirsty and has to come back. Pegging our little safety measures here using the PSAR as a proxy for our intuitions about reasonable profit preservation and capital preservation stops once the trade starts working in our favor. The Bollinger Band's giving us the river, 30-period Bollinger Band plus or minus 1. The floodplain, 30-period Bollinger Band plus or minus 2 is a lighter shaded area. And then the thick red lines are the Z3 lines, the Bollinger Bands plus or minus 3, which gives us an indication of the edge of normality, and which gives us a bright visual on the extremes of rational movement in a market of this type. So we've got a lot of things going on. Let's see how we build this chart from the ground up. And let's start with, let's not forget that we have volume at price over here on the side to give us an idea of the amount of interest in volume at each price during the look back period, which gives us some insights like market profile. So let's take a look at some theory and a metaphor for our learning first. And I want to talk about the regression lines first. So the metaphor that we're going to use is that there are different categories of market participants. I want to talk about the traders and the holders, and then the wise guys. And I want you to think of the traders like foxes. And these are quick, fast, shifty dudes committed to their awareness, their alertness, and their agility. That's where their edge comes from. That's their nature. And I want you to think of the holders like little hedgehogs, committed to their judgment and the correctness of their analysis with some patience. They do one thing, they analyze the market, they find fair value, they get it right, and then they hold on to that judgment in the face of contrary evidence and are slow to change their minds. Foxes, on the other hand, are quick to react and are looking for price momentum and shifts in the trend. The owl and the tortoise, that's who we are. We're thinking with wisdom. Thanks to the owl and the tortoise, gives us persistence and patience, discipline. I want you to think of regression lines as the proxy for price for the traders, and a proxy for fair value for the holders. And then our job as the owl and tortoise is to observe the difference between the trader's opinion about price and the holder's opinions about fair value. In the differences of opinion between those two groups are created opportunities for trades of various sizes. And when that disagreement is significant, we can frame favorable reward to risk ratio trades. When both of those populations are in agreement, then the stage is set for a breakout by the traders to start moving the price in one direction away from the holders. So I want you to think of the traders are folks concerned with price momentum, momentary advantage, and rely on agility. And that the holders are concerned about long-term value, and they're looking to buy at an advantageous price and then hold for value. We're going to use 4 regression lines. The fast pair really governs the behavior of the traders, and so we're going to use the 10 period and the 30 period regression lines. The 10 period is the fast, the 30 period is the slow, and that's going to be the proxy for price. So the fast traders look at the 10 as the price, the smooth price, and the slow traders look at the 30 as the smoothed real price. In the slow pair, the 90 and the 270, we're looking at the holders. The fast holders consider the 90 to be the fair value. The slow holders consider the 270 to be the fair value. What we're going to look at quite often is the difference of opinion between the fast traders and the 10 and the slow holders who use the 270. And that's going to set up our regression line fractal framework system. Our standard description practice is going to be the 10 regression line. We always color code blue, and that's the fast trader's price. And the 30 period regression line is black. That's the slow trader's price. The 90 period regression line is green. That's the fast holder's fair value. And the 270 regression line is coded purple. That's the slow holder's fair value. You'll notice that there's factors of 3 in between members of the pair. And the reason is that when the trend is in the same direction, the fast and the slow trend, the lines overlap. When that trend changes and you get 10 bars of price in a different direction, in 10 bars, that 10-period regression line has completely changed its direction. But 2/3 of the slow regression line in that pair are still pointing in the old direction, and there's still 2/3 of the price has to adjust. And so that gives us time to react and make our trades before both regression lines are in complete agreement on the new trend. So the 10 period times 3 gets us to 30. The 30 period times 3 gets us to 90. The 90 times 3 gets us to 270. And this creates that fractal framework as a function of threes. And so we look at the extremes. We look at the differences between the 10, the fast, and the 270, the slow, slow. When there is a large difference of opinion between the fast traders and the slow holders, the conditions are created for a trending move to resolve that tension. They both can't be right unless they're going to meet somewhere in the middle, and then they both have to change their opinion. If the holders are correct, the traders run out of steam, they can't convince anybody else they're right, and price reverts back to the long-term mean. If the traders are correct, then the holders will slowly change their mind and move towards the new price that was discovered by the traders. Most of the time, the long-term holders are correct. The longer it takes for price and fair value to meet, the more likely it is that the holders are correct. So let's take a look now at how this unfolds on a chart. Let's build our chart from the ground up using the free stock charts.